Greetings, everyone. I'm glad you're able to join us today for the second session of our National Church Virtual Seminar. My name is Mark Yoder. I'm a partner with CapinCrouse and Carr Ingram here in the Phoenix, Arizona office. Uh, just a few housekeeping matters, and then we're going to get started here. Um, if you're requiring CPE, we are offering a 1 credit for the field of management services, and it's calculated at your attendance at 50 minutes. Partial CPE will be offered in half-hour increments after the first 50 minutes of attendance. We hope you have logged in with your unique link so that you can we can send the information based upon the email that you provided to receive your credit. You must answer 3 polling questions per this time to receive the credit, and you must log your attendance for a minimum of 50 minutes through this email. Certificates will be distributed within 7 days of this event to the email that you registered with. Questions about the certification process can be sent to marketing@criadv.com. And then there will also be a survey at the conclusion will be launched to provide your feedback. We always find that very helpful as part of the process to kind of what we do and for future events. So please fill that out. And then also there is a Zoom chat function available. You can post your questions there. And when this is kind of a little bit different from the first session if you attended, this is meant to be highly interactive. And so we are expecting participation. Hopefully we can get to your questions throughout the course of our time together. If not, we will make sure to follow up as we're able to. So let's talk about the objectives today. We're going to be talking about current economic conditions. Kind of interest rates is on top of everyone's mind, especially with the Fed cutting rates and the Fed cutting cycle, if you will. And so we want to talk about how that's going to impact church financing. We're going to talk about the potential pros and cons of the various lenders that are out there. And we have 3 organizations represented on the panel today that are very active in the church market. And then we're going to talk about some best practices, how to prepare for that next loan or refinancing. So that's kind of the agenda is kind of an outline of what I just said. I am going to stop sharing my screen so you can see everyone better. And so I have 3 gentlemen with me, and I'll introduce them very briefly. But I've asked each of them if they could just give a little bit more additional background on themselves, just to kind of help them introduce to our audience. And so I have David Lee with Thrivent, Norwood Davis with Wesleyan Investment Foundation, and Dan Mikas with Cass Bank. Each of these gentlemen represent an organization that provides lending and other services to churches. And they are a national player across from west to east. So no matter where you are, they probably lend in your area. And we invited them to be part of this panel discussion for that very reason. We respect organizationally what they do. We see them frequently within our client base and just working with churches. And so we're excited to have this panel discussion today. So I'm just going to go based upon the order of my screen and say, hey, David, can you just share a few words about yourself as you introduce yourself to the group here?
Sure, absolutely. Again, Mark, it's a joy to be able to be a part of this, and thanks for allowing us to be able to invest into the kingdom work of what you guys are all about. I'm with Thrivent Church Financing. I've been in church financing for now about 34 years, 25 years with another institution, credit union, and 5 years with the bank, whom I've had the opportunity to be able to serve alongside with Dan, and then now the last 4 years here at Thrivent Church Financing. Over my career, I was also on pastoral staff for 25 of those years, so bivocational, and currently serving as a co-lead chair at my finance committee at my church. That's about a $4 million budget, running around 12, 1,300 in attendance. So excited to be a part of this and try to figure out uh, navigating this journey with you all.
Very good. Thanks, David. All right, Norwood, I have you next.
Norwood Davis. I'm the president of the Wesleyan Investment Foundation. We are a multi-denominational, non-denominational lender founded by the Wesleyan Church in 1946. But we currently serve 44 different denominations, associations, and networks of churches, about a little over 2,900 churches in all 50 states and several Canadian provinces. So we're excited to be able to participate on this panel. I come to this role with about 20 years of experience as a multi-campus church CFO in the Atlanta metro area, 12 Stone Church, where I oversaw finance, IT, facilities, HR, marketing, all the business aspects of the church. During my tenure there, built 8 different campuses and financed every single one of them through the Wesleyan Investment Foundation. So I have been both a borrower and a lender now. So I've been on both sides of the table.
Very good. And Dan?
Hi, Mark. Thank you. Really a pleasure to be here with all of you today. I'm with Cass Bank, and Cass Bank's been around since 1906. But in recent decades, it's evolved into 2 distinct, separately synergistic linked companies. Cass Information Systems, a publicly traded provider of invoice payment and expense management solutions, and Cass Commercial Bank is a wholly owned subsidiary of Cass Information Systems. So Cass Information System provides Cass Bank with additional liquidity in that they process over $90 billion a year in payments for its clients. So that's that float on those payment processing is free capital for us. We're not a retail bank. We don't have branches. We don't do any consumer business. So there's never any question about, availability of capital. It's interesting to note that Cass Information System was recently approved by government agencies, the defense sector in particular, the General Services Administration's team to process payments for the government as well. And they wouldn't do that, of course, if we didn't have a really high credit rating. We consistently get the 5-star credit rating and superior rating by all the bank rating agencies. I personally been at this for 34 years, kind of like David. Started off in the securities industry, did church bond offerings for 7 years, did about $1 billion in loans under that format, Series 7, Series 24 supervisory license, and then 22 years at a large bank based in San Francisco, did another $4.5 billion in loans there. And then when that bank got sold, I joined Cass Bank about 5 years ago. So this is what I've done my entire career, and I see it as a helps ministry kind of calling, and really take a lot of pride in it. $5.5 billion in loans, 2.9 million in losses, which is, by the grace of God, unheard of in any commercial lending category.
All right. Very good. Well, thanks, gentlemen. Appreciate it. As our attendees can understand, there's a lot of experience sitting here on the panel. And, our hope coming out of this is just that whether you're preparing for a future financing, a refinancing, whatever is coming in down the road for you in terms of your church and accomplishing its vision, that this is a great way to prepare for that in the days to come. So gentlemen, and we're kind of designed this just to kind of jump in where you see fit. But I'm going to point this question first to Norwood, and then have David and Dan jump in and discuss it. But I like to kind of start with that, where we said in the opening that kind of want to talk about the current interest rate environment. Obviously, the Fed is doing some action and lowering rates. It'll be interesting to see what happens with long-term rates. But I guess my first question is, if you're a church and you see either a maturity or an interest rate reset happening, let's just say within the next 18 to 36 months, uh, what do you guys with Wesleyan Investment Foundation kind of see on the horizon, and how are you kind of counseling churches in this current interest rate environment?
Yeah, well, it's interesting. We're coming out of kind of a season from 2020, late 2022, early 23 through really late 2024, where interest rates were really not following kind of traditional models. It's in what's called a yield rate inversion, where short-term rates were, markedly higher than long-term rates. We're starting to see that come around from last year and starting to stabilize, but it's still a little bit of a interesting market where you still got, relatively speaking, higher short-term rates, lower midterm, and then kind of back up around short-term rates on the long end of the yield curve. So it puts kind of lending in a really interesting dynamic. Borrowing. We're watching obviously what the Fed does. I would say this to most church borrowers: don't realize that the Fed, whatever the Fed does, doesn't necessarily show up in a long-term credit facility, mortgage, or a line of credit. Those really kind of go off of the mid part of the yield curve, so 5 and 10 year treasuries, depending on how things are structured. So those are the rates that really someone should be paying attention to and seeing what's happening there. We do, as we're looking, we do see that there's going to be a period over the next 12 to 24 months where rates will come down. And, over the next 24 months, we're expecting about 1% or 100 basis points kind of drop. So that's where we're at in the market and what we're seeing. The way most of these rates are priced, or most of these loans are structured, there will be an adjustment depending on the term of the loan in 3 to 5 years. So it's not like a 30-year mortgage. There's opportunities to adjust it in the future.
Yeah. Yeah, and part of that reason why I'm coming up with that question and kind of giving that time frame is, at least within my client base, I serve a large number of churches actually across the country. Everyone took advantage of lower interest rates during the pandemic era. It was like it was an opportunity to lock in those low rates. And now, just for those shorter periods that you're mentioning, seems like there in the next 12 to 36 months, I see a number of my clients are having an interest rate reset. It's just time for that to
Oh
occur
yeah.
and so that's where it's going to be an interesting dynamic for, I think, a church as they kind of navigate this to kind of say, okay, where's that reset going to be? And, do I pull that trigger earlier based upon the cycles, or do I kind of wait to see where we land? And so, Dan, since you're more of a traditional, I know your structure is atypical, but you're a bank. As you kind of work with your clients and you kind of see these resets happening, what kind of words of encouragement are you giving your customers as they're looking to likely do a loan here in the upcoming 18 to 36 months?
Sure. Well, we are at a really unusual point in time because, we've just seen 2 quarter-point Fed rate reductions in September and October against the backdrop of inflation, which is still stubbornly high at around 3.1% versus a target of 2%. Normally, the Fed would not be lowering interest rates against that backdrop, but they've had to do that because they see some weakening in the job market. We've got a great unemployment number, at least last time we got a government number, it's 4.2%. But we've got weak job creation and low labor availability. So that's why they feel like the economy might need a little stimulation to stave off any, further, reductions in the workforce, any kind of, recessionary type characteristics like that. We got a good ADP number this morning, private employment up 42,000 jobs versus an expectation of 30, but no additional rate cuts expected in December because of the basically because I mean, just to use Paul's words from last week, when you're driving in the fog, you drive slower. We're not getting any economic data right now. But yeah, like Norwood said, we see rates drifting down. We expect the Fed will lower, but again, that only impacts the lower part, the shorter part of the yield curve. So that's going to impact what you get paid for deposits, not necessarily going to impact what you pay to borrow money for a church loan. That is going to be more dictated by, things such as, inflation, because the bond traders dictate that, not the Federal Reserve. So inflation, budget deficits, geopolitical issues. So yeah, that those rates may not change much because, we price off the 5-year US Treasury when offering a 5-year fixed rate. Now, to your point, I think, a lot of churches right now maybe got a 5-year fixed 4 years ago when rates were much lower. What do they do when, facing a rate increase? For us, it really, I mean, we talk to the church as well in advance of that to help them anticipate that. But it really hasn't been much of an issue for us. And I think part of that is because we don't allow a church to spend more than 30% of their core giving on debt service, whereas I think one or two of the other lenders on this call will go up to 40%. That's a lot less flexibility in your budget when it comes time to maybe realize an adjustment on your loan rate and a higher debt service payment. So we haven't had too much concern about that. Most of the churches are anticipating it, and we're talking to them, talking to them about it in advance.
Yeah, David, I'm going to keep
Yeah.
us on track here by launching a polling question, but if you just want to add any
Yeah.
additional perspective while people are answering that, that'd be good. So I'm launching the first polling question, and it'll be open for about a minute to give people an opportunity to respond. So, David, any final thoughts before we change subjects here?
Yeah, I think both Norwood and Dan bring up great points in terms of what we anticipate potentially what rates may look like. But one of the practical ways that what we try to encourage churches to do, and we'll sit down with the churches, talk to your lender, and we talk about what's called a shock test. You want to shock test your loan, meaning if in fact 4 years ago you got the loan and you have a rate adjustment coming up, or in fact a balloon, you'll want to shock test your loan based on what the current market rates look like. If you were at a 3.5 or 4, and now it's probably looking at more like a 6, 6.5, 7, you'll want to be able to project out what the potential P&I payments may look like and how that impacts your budget. Because everything's based on cycle. As you're entering into a budget cycle, you'll want to know what kind of impact that's going to have. So the number we kind of play around with is for every 1% increase on every $1 million, you're probably talking about an increase of about $10,000 a year in expenses. So do the math real simple. That helps, and that's kind of how I talk our finance committee through that journey, as we have a rate adjustment coming up on our end. So
Yeah. And so we had we have about 280 people on this attending this session, and interestingly enough, over half of them are mortgage free. So that's
Praise
interesting.
God.
And I always love to see that when I just had a church recently being able to celebrate that they've been able to pay off their indebtedness. That's always a great point. But I think an important thing about this is that, as we all know, visionary churches always have opportunities, and so we'll talk about if there's a merger that they're discussing, or an assumption of debt, some things to be considered there, but we'll get there in a moment. So one of the reasons why we selected these three institutions is, like I said, their national presence, but they're also, we see a lot of kind of disbursement amongst the clients. We see local credit unions giving to churches. We see retail banks, community banks. There's all sorts of them. But one of the things that I wanted to have this group discuss, and Norwood and David are have promised to be nice to Dan, so they're kind of the more non-traditional lenders, if you will. But I'd like to kind of start with some distinctives between, working with whoever your existing lender may be, but as they kind of consider if that rate reset's coming and they don't like the initial news or kind of where things, they're like, we need to open ourselves up to the marketplace. And I always encourage an existing client that you need to check the market just to see what's happening, because there are differences out there. But let's talk a little bit about the differences between a Wesleyan Investment Foundation and Thrivent Church financing versus kind of a traditional lender, if you will. So David, I'd like to start with you and kind of helping the church to understand what they should be looking for in a lender.
Yeah, I guess I would be the weird duck in this journey because I've kind of lived in all three worlds now, at the credit union, at the bank, and now with Thrivent Church Financing. So I appreciate all aspects from all the different ways that credit unions and banks and denominational institutions will actually fund. I think probably some of the biggest pieces is, for Thrivent specifically, we don't have maturities, right? We don't have a balloon. So those are events that typically, in a general sense, in national church lenders, credit unions or banks, they would have a term, whether it's a 5 or a 10-year. At the end of that term, you'll actually have a balloon or an event if your loan isn't paid off by then. So what that puts the church in a position is you have to requalify. So depending upon what your church may look like. So we don't have that event. One of the big things, it's a source of funding. So, both for, I think, Wesleyan Investment Foundation as well as us, our core deposits in terms of what we're looking for capital to be able to fund, we don't require necessarily depository of banking relationship transitions. That's a heavy lift for churches, right? Some are volunteer led. The loan, I always say, is usually the easier transaction. Changing a banking relationship, it takes a lot of work. And so we don't have that requirement. That doesn't mean it's a good or a bad thing. It's just recognizing and acknowledging you're going to have to make some of those transitions with a typical bank or credit union model. But for the most part, I mean, we're fairly similar in terms of the underwriting criteria. You have, the loan to value, standardized loan to value requirements. Those will range anywhere between 65 to 80%, leveraging debt to income, how much you could actually borrow relative to your unrestricted ties and offerings, debt coverage. So from that vantage point, you're going to be looking at somewhat similarities. Those ranges will change for the most part, but I'd say if differences, those are probably the big ones.
The only thing I would add to what David's articulated is typically when we're refinancing a loan from a community bank, and we really see our primary competitor as a community bank,
Yeah.
really at the local level. Someone on the church board is or connected to the church is a local bank executive. And that's primarily who we see our competition from. But typically what we'll see in those kinds of deals is in addition to what David has said, which I agree with all of it, is also typically bank loans, commercial bank loans will have a lot more covenants in them, and restrictive covenants, reporting covenants that we typically do not have. Even in some community banks, you'll even see them requiring personal guarantees of a pastor or church board members. We don't require that, just given our theological bent on that. So you'll see some of those kinds of non-financial terms that are embedded in those kinds of commercial loans with what I would call a secular kind of bank. I do consider Cass in a different category because I think they have a missional element. They're not just a community bank, so they have a strong missional element as well. That's different than a typical national bank or or even a community bank.
Yeah, thanks for that, Norwood. We do, and the bank's been doing this for 30 years. We don't really have any covenants. We do require a CPA statement if the loan is large enough, each year. We've never in my 34 years, I've never required a personal guarantee. And yeah, we do have balloon loans, but at renewal, we don't require any cost. No new appraisal, no title insurance, no origination fees, really no anything. Just here's the documents, and we roll on. But I think the main difference for the listeners, and when they think about borrowing, the first question they always have is, what's your interest rate? So I think the glaring difference amongst these three institutions right here on this call is, where do you get your money? We're banks, so we get it from depositors. Those investors, if you will, require less reward because they see less risk. We can FDIC insure up to $50 million in deposits for a church. So, we pay less for the money. And consequently, we can lend it for less. We're doing 5-year fixed for 5.9 right now, 10-year fixed for 6.1. So, that's the main difference, is we have a lower cost of funds, and so our interest rates are lower.
Very good. Yeah, no, I love it because number one, as an auditor, when we pull these loan agreements, especially new loan agreements, and there are things that I always kind of encourage. If I get ahead of a church client in a refinancing, I always share with them that there are differences in lenders, and there are these at times these EBITDA requirements, a debt coverage service ratio, and otherwise. And so my encouragement is, one of the reasons why you can move beyond who your existing lender is I think it's not always about rate. That first question, Dan, that you just mentioned. I mean, it's about, well, what is the nature of the ongoing relationship? What are the requirements? And one of the things I always kind of give some encouragement on is, there may be some things in there that you can negotiate on. Because you just mentioned, Dan, that there could be a requirement to have an external financial statement. Sometimes, more times than not, that's a review or an audit. But in my experience, lenders tend to have flexibility on those and wanting to understand, what is the quote unquote requirement of the loan versus how this could be structured. And I think too often, an ex-pastor or the CFO of the church may not know that those things are negotiable. So just to kind of open this up for a general question, do your three institutions tend to be negotiable on kind of those ongoing covenants and or ongoing loan requirements as you work with a particular church? Dan, I'll let you go first.
Yeah,
Sure. Yeah, we don't have DCR covenants, and on a rare occasion we might have a operating reserve covenant, but it's pretty uncommon. So it's a pretty user-friendly product. And I'm sorry, what was the remainder of the question?
Just that, I mean, you do have the ability to kind of a give and take in
Thank you.
terms of
Yes,
what you're requiring.
absolutely. Yeah, there's a sliding scale. If it's $1 million loan, and that's our minimum, we might require a CPA prepared statement. If the internally generated statement they provided look reasonable, if the net income foots to the year-over-year change in fund balance and things tie reasonably well, we may not require a CPA statement. At 2 million, we're going to require at least a compilation. At 4 million, we're going to want a review, and above 5 million, we're going to want an audit. So there is a sliding scale there. And there are times when exceptions can be made. Maybe it's an audit every 2 years and a review on the year in between, so that it can be a little less expensive and a little less busy work for the borrower.
Yeah.
Yeah, I would say don't be afraid to ask. Don't be afraid to ask, because it's important for, especially us as church lenders. We want to know what your missional objective is as a ministry, because we have missional alignment. What's important for us is making sure we're partnering together and serving a church that's making an impact in their community for the kingdom, right? So don't be afraid to ask outside of the terms. For example, a church came to us and asked, "Hey, we want a 13-year fixed rate." Okay, can you cash flow? Great. We just created the product when we created a 13-year fixed rate option, right? So standard is 5 or 10. I mean, we could have up to a 20-year fixed rate. And so, I mean, rates right now, Dan brings up a great point. In terms of the competitive nature of rates, denominations, absolutely, we rely on different sources of investments, but keep in mind for Thrivent, I mean, we're a $200 billion institution that have different sources of funding. So yeah, to give you some level of comparison, very marketable. We'd be, for example, a paper credit down to the mid fives, right? So 5 is a number you could play with today. Absolutely. If you have an adjustment coming up, have the conversation and ask what you want. Do you want alternating financials, review audit? Ask, because when you have competition coming in, it ultimately benefits you as the ministry. And that means when you can save more, you can reinvest back this savings back into your kingdom work. And that's what matters for us.
Yeah,
Love that,
I would.
David. Don't be afraid to ask. So go ahead, Nord.
Yeah, I would just echo some of that stuff. I would say, right now we're very competitive. I mean, we're managing the yield curve, even though our sources of capital are different, and we're finding ourselves very competitive with commercial banks with traditional sources of capital. Um, I think there are a couple of different nuances that I would add in there. Yes, we're able to structure things, quite differently, quite uniquely. WIF, we literally have loans on the books from $5,000 to 75 million. So pretty broad range. And we structure that uniquely, everything from a rural church in Iowa that needed $5,000 for a roof replacement to a multi-campus nationally known church, with multiple campuses. One of the things that we like to see ourselves is not just a lender but really a partner for the vision of the church. And typically when a church will come to us with a project, we really ask them and try and help design a program not just for the current project that they're looking at, but for what are they thinking 5-10 years down the road, and how do we structure, particularly as we look at our competition against community banks. Our lending limits generally are much higher. And so we can really work with a church that, particularly those that are fast growing, to help them know that they've got capacity, even beyond what the current loan request is. And that, 5 years down the road, when they launch the next campus, they're not going to have to find themselves refinancing the loan that we're doing on this project, because we'll be able to come and help them with that next one. So there are a lot of things to consider other than just price. But I would say that, even some of the non-traditional lenders like WIF are quite capable of being competitive on rates.
Very good. So I'm launching the next poll question. Give people an opportunity to answer this. So David, maybe you could be thinking about this when I end the poll here. I'm kind of curious, can you give an example that in your working with churches, what is one thing that most churches are surprised about during a loan evaluation process? Like what comes up that fairly routine that happens?
Yeah, it's with any lender out there, the 3 included here, in addition to any other lenders nationally or local community banks, we're looking at the basic financial information, right? Ratios, trends, direction, the overall financial health of the church. But I think that the piece that is probably the most critical, because if you give us a spiritually healthy church in terms of governance and leadership, I think churches are sometimes a little bit taken aback, and they're like, you're digging that deep into that area. And it actually has to do with, they get surprised at the level of due diligence that we go into the intangibles. So, for example, board governance. We're going to dig into those bylaws. I mean, Norwood's not, nodding his head because we understand it. We understand that church nuance. You give us a very transparent, accountable, well-governed church, that begins to uncover the character of the leadership. Bylaws, succession planning. We want to know succession planning. Do you have plans in place? Because we all know our days are numbered. And so how are you going to continue as a ministry? Because, we're in this relationship a long time. And it may go beyond the tenure of the senior pastor. So succession planning, we actually do dig into the social media. We want to know what social media and the community says about your church. Are there things that we would be concerned about as a lender? So we dig pretty heavily into that. So ultimately, we're trying to get to the character of the leadership and the character of the church. So yeah, it's tough to get your arms around, but it's very, very important.
Mhm.
Very good. Nora, would you have anything to add there?
I would echo that. I mean, we spend most of our time on the intangibles. I mean, once you spread the financials, that's pretty easy. It's all the intangibles. I like to tell pastors that we actually bet on the horse, not the track. And most churches come and say this is going to be a great building. And to David's point, the intangibles are so much more important in today's social media world, and with succession and all the different kinds of things that we're seeing happen in the church now. Oftentimes, our loans outlive the senior pastor that took it on.
Yep.
Yeah, the governance is certainly a good point of focus. For us, we look at the bylaws, we look at the board composition. The people who are supporting the leadership's decisioning, local active church members, or are they pastors on the far corner of the continent who don't necessarily have a perspective on the donor sentiment towards supporting, an aggressive physical plant expansion plan, for example. And it's not to say that we won't make loans to, churches with boards that have members that are remote. But it's something to consider. I would say probably the biggest surprise, though, that seems to strike churches, to kind of go back to your core question, is the borrowing capacity. Oftentimes, churches start off with a discussion with the architect and a builder, and they cast a vision, with a schematic, and then they talk to the lender kind of later in the process and find out it's going to be hard at current construction prices to get the sources and uses in balance. In other words, to qualify for enough borrowing capacity to actually fund the scope of the project that they've conceptualized.
Okay. So now that we've talked about kind of the differences and unique aspects of the institutions represented here, I want to kind of take us into kind of a third section, that dealing with best practices and preparation for that next loan or refinancing. And so Dan, I'll start with you. We kind of talked about you know getting improving, but what is one thing or a financial practice in your experience that a church often overlooks as they prepare for a loan approval process? Is there something that you would really encourage them to kind of, hey, this is what we're wanting to understand as we evaluate, entering into a relationship with the church?
There's a smattering of different topics. I wouldn't say there's one consistent point of focus there. I mean, we're going to look at cash reserves. Have they made it a practice historically to maintain an adequate operating reserve? We're going to look at last year in particular, and to some extent the year before, to see what the debt service capacity was in those years, relative to the amount they're requesting. Could they have managed that? We're going to look at, do you have equity in your property? You can borrow 100% of what you need for a subsequent building phase if you have, adequate equity in the existing physical plant. So those are some of the things that I think they need to, kind of anticipate.
Yeah. And Norwood and David, just as you kind of be thinking about this question, I mean, one of the things that is definitely happening, Wall Street Journal published an article on this talking about construction activity in the church world is kind of at its highest level since the early 2000s. And so, and I'm assuming that this is a large part of uh, your originations as well as construction loan activity. To this so far, we've kind of talked about an interest rate reset or maturing loan, but maybe if you want to kind of, as you kind of hear my question to Dan, maybe kind of tailor it to and kind of give some consideration, as a church is looking at doing a construction project, how that may differ, or how they may need to prepare for a project like that as opposed to an historical loan. So, Norwood, I'll let you start with that in terms of, incorporate in kind of a construction loan activity as a church may be considering.
Yeah, great question. Well, currently we're seeing about 55% of our loan applications driven by some kind of construction. There is an uptick over the last 2 years, but it's still way down from the historic highs. I will say this, I think, having built 10 different construction projects over 8 campuses over 17 years. And then even what we see now, I think most churches right now are surprised by the cost of construction. It is considerably higher than it was pre-pandemic. Some of that's driven by tariffs, some of it's driven by just inflation, and some of it's driven by access to labor in the construction trades. So it is significantly higher than it was pre-pandemic. But I would also point out, I would say this, I think a lot of churches are surprised by our expectations around cash reserves. In Ecclesiastes, it says, give portions to 7, yes, even to 8, because you don't know what disaster may befall the land. We look at the story of Joseph, and if we look at it from the story of Egypt, reserves were set aside about 20% a year. If you go and do the math, 20% a year for the 7 years of feasting to handle the 7 years of famine. And that gave Joseph and the Egypt staying power. It gave him buying power, and it gave him blessing power. And so there is an expectation that churches have reserves and that they steward those well. And so we really look for that. So I would encourage churches really to have a strategic thought around what their reserves are and should be. Where do they invest those reserves? Are they doing kingdom work, or are they investing them with a commercial bank? That's one of the great things about WIF. They can not just borrow from us, they can also invest and get a higher yield than they would in a money market fund or some other kind of liquid device. That gets their net borrowing cost effective rate down. But it's important for churches to have reserves and not just spend everything that they have on current operating expenses. You see all the time. I mean, we had a church recently, very, very unfortunate situation, but had a senior pastor that was unexpectedly diagnosed with terminal cancer. And had a leadership transition that took the better part of 12 months to continue. Well, that requires extra cash, and you got to be prepared to have those kinds of things as you move through those processes. So I would echo what Dan said about that.
Yeah, real quickly, David, let me just insert something. I'll give you a chance to respond to the question. It has been nice to see. I mean, I've been doing this for a period of time, nearly 25 years. And I would say pre-pandemic, the level of reserves was noticeably lower than it is today. And I mean, there's various reasons for that, but where the discussion used to be is 30 days adequate. I see that discussion being more like 90 days. And we monitor that. We provide that as part of a church financial health index of measurement. But we definitely say that, it was really tough there during those pandemic years, navigating things, keeping employees paid. Obviously, there was government assistance that was occurring, but we're not seeing a reversion back to those lower reserve levels, which I think is healthy and allows for. I mean, obviously, that was such a macroeconomic event, but for like a passing of a pastor or a sudden thing like that, you need those to kind of help to navigate those things. So reserves are indeed important. David, thoughts?
Yeah, yeah, that reserves might sound like another webinar that you can tackle right in the future. But yeah, the same kinds of issues, obviously reserves. But when you talk about financial practices as a church is thinking about whether it's a construction project, I think to Dan's point, yeah, a lot of churches unfortunately put the cart before the horse where they have the dream, right? The architects, there's some great, wonderful church architects, but that probably ought not be the first meeting you ought to have. Because if you have the vision and the dream, and all of us are probably on the operational side, is like, yeah, you put an architect together with a senior pastor, and they'll dream just about anything, and an architect will design anything that the pastor dreams of, and then we end up coming on the back end. It's like, hey, here's a $20 million project, but your budget's $2 million, right? So now we're going to have some tough conversations. So I would say understand what your capacity is well before. And what would it take for you to get there? And lenders like us with experience we should be able to help navigate you through that. What do you need to do? Do you need to build more reserve or capital into the project? But yeah, for us, boy, last year in 24, we were probably 90% construction. This year, probably more like 75. But I think I think something's even more exciting, including the Wall Street Journal, is you know what? The church is making a difference. Healthy, growing churches are making an impact in their community. But also recognize this. A bigger building or your construction project will not fix spiritual related issues in your church. So make sure you get spiritually healthy. Make sure you have good, prudent financial practices to get you ready for this race that you're about to run. So if you're 2 years out, have that conversation now. Don't wait 6 months before you're going to have to break ground, because by that time it's too late. So, and then other partners, capital campaign consultants, it's really a team. You have to formulate the right kinds of team and partners into your project as you begin navigate moving forward. But there's a lot of other pitfalls that could be another great seminar and webinar coming up.
Yeah, very good. All right, I need to launch another poll here. My lender requires the following type of financial statement as part of the loan. So just a quick check-in, if internals are sufficient, if you need an external, or once again, you're mortgage free, so you don't have that requirement. Just a few more moments.
Mark, while they're answering that, I saw a question from about adequate reserves, a couple of different questions about what do we consider adequate reserves.
Yeah.
And I'll answer that if you don't mind. But
Yeah, no, jump
you know,
right
I
on.
think we look at really a minimum of 90 days cash on hand on kind of core operating expenses. But I would say strategically, it really depends on what your strategy is. When I was CFO at 12 Stone Church, we were in a transition where we knew we were going to go into a transition season with our senior pastor in succession. And in advance of that, we actually built up strategic reserves to a little over 250 days cash on hand, really just to manage that transition season. And if anything unexpected happened. So there's a lot of different, we built up strategic reserves when we knew we were going to do we were going to launch multiple campuses in portable space. So we built up cash reserves over about a 2-year time frame where we were planning that. So I think to David's point, if you wait till you get 6 months before something is too late, and I always like to say you got to dig your well before you're thirsty. So make sure it really is driven by your strategy, but adequate would it be, probably at least 90 days.
I would agree.
Yeah, whenever I have discussion at the board level in terms of what an adequate reserve is and everything, it's always interesting. It kind of it's very much it can be personal to that church and just their methodologies and everything. But when someone asks me point blankly, what do you think a minimum reserve would be? I would say 90 days is my general advice. And so sounds like it's pretty much in line with what the lenders here are looking for as well. All right, gentlemen, we have about 10 minutes left. I'm going to scour the question Q&As here in a moment, but I'd just like each of you just to kind of perhaps give one final thought in terms of a word of encouragement to that ex-pastor, that CFO, in terms of as they're kind of navigating, the current conditions, and just what would you kind of give them to kind of encourage them in these days ahead in terms of their next financing. And so, David, I'll start with you on that.
Yeah, and I think we kind of touched on this a little bit in different ways, but I think the biggest thing is communicate early. I think it's the concept of, time is your best friend right now. Don't make it your worst enemy, because you'd hate to have to make decisions and rash decisions because you're being forced into a situation where you have either a balloon coming up or you have the rate reset and it's going to adversely impact your budget to the tune of, significant impact on adverse impact to your budget. So don't make it to the point where you're being forced into those conversations, and have ongoing conversations. It's not just a one. That's why we call it a relationship. You don't just talk to your partner once and say, hey, we'll talk to you in 5 years. Have that ongoing dialogue to share what the future of your ministry is going to look like, and bring in the experts to be able to help formulate and navigate a financial plan to get you there. And so I would say, I mean, we're people, right? We're believers. We get the kingdom mandate. We're not just bankers and people in the financial institution industry. We love Jesus just as much as you do. So, let's partner together and keep that communication line open. And hopefully we'll be able to provide a little bit of insight and wisdom into that.
Thank you. Dan, thoughts? Final thoughts?
Yeah, if you're a pastor and you're looking at borrowing for the first time, I think the best thing that you can do is talk to the kind of people you see on this call that do this all day, every day, because their yes is going to be yes, their no is going to be no. They're going to be able to guide you through the process in a very predictable and efficient and quick fashion. To the timing point that David raised, that's a good one. You want to make your lender selection, your final lender selection, about 90 days before you break ground. And you never want to break ground before you get the loan closed, because that creates lien priority issues and title insurance issues. So, there are folks out there, and listen, you can pick up the Church Executive Magazine or go to the Church Network, formerly known as National Association of Business Administrators website, and you can see the vendors advertising there who do this all day, every day, and they'll speak your language and they'll guide you through the process.
I would
Thank you.
echo what Dan says. Is just find a specialist that shares your values, and just don't go to the corner bank or who you necessarily have your checking account or operating account. And for the sake of the kingdom, do not go to one of the major national banks that have trillions of dollars. That is not who you need to borrow from. Scripture says that the borrower is servant to the lender. So don't pick a pagan slave master.
All right. Well, first of all, gentlemen, I just want to say thanks. I'm going to be launching the final poll question here momentarily. A lot of wisdom amongst this group. And, in the end, this isn't really about equipping everyone to make the best decision, an informed decision as they kind of navigate the healthiness and the vibrancy of their local church. And so I personally want to say thanks to David, Norwood, and Dan for their time here. I'm going to launch the next poll question and then just kind of come up with some closing comments here. So just a second. Hoping for a true response here for today. So, just the final poll question for those who need CPE, you'll need this. All right, just a moment longer. And so here, as we just wrap up our time together, you can follow CapinCrouse on social media. We're on all the different platforms. So, we often provide updates and, connection in terms of thought leadership, connection to resources, etc. So really encourage you, whatever is your favorite channel, to find us out there and connect with us. We also have contact information for the presenters here that feel free to reach out. I know Norwood has a team, so he'd probably refer you, but Dan and David cover certain areas, but there's always a way to be able to make this initial connection. I would say that these slides are available for download, but there's not a lot on them. But you also will receive a recording of this session so that you can go back to it as you best see fit. But once again, I think we'll just bring this to a close and just thank everyone for their time and trust you enjoy the rest of the seminar today. Take care, everyone.